This is Taking Stock on Bloomberg. I'm Pim Fox. Now, we've been talking about the clean energy bill at the House voting on. This is Obama's cap and trade legislation, part of limiting greenhouse gases. Well, it does involve cutting back on electricity in some form or another, something consumers have done as they try to save money. Now, it's part of the reason utility stocks perhaps have underperformed for much of the year, but there is evidence that the tide may be turning. The S&P 500 utilities ending the week higher. Will defensive investing be a theme for the second half of the year? Well, let's find out some more details about what's going on in utilities. We have Paul Fremont. He joins us from Jefferies and Company, expert in all things utilities. Paul, it's good to have you with us. Thank you for coming in. Before we talk about the sort of broad picture of utilities, I want to ask you about some work that you've recently done that looks at a gap in valuations, because this could be important for people that are trying to decide where to place their money if they want to buy utility stocks. And you kind of come up with another tool to measure value in utilities, right?
Correct.
What is this gap? What is this? What was the problem in the first place?
Well, I think there's a certain amount of distortion that's created by hedging strategies employed by managements, where you lock in near-term profits and cash flow at a fixed price, but ultimately, when those hedges disappear, maybe 2, 3, 4 years out, you're left with essentially market prices and whatever you are selling your generation for. So to the extent that you can look through the hedges and basically price the output at market prices, everybody then is placed on a level playing field, and you can cross-compare these companies. And when you do that, you find that some companies, basically Constellation, Entergy, NRG, are trading at a very low multiple of cash flow, 5 or 6 times. While other companies, such as Calpine and Dynegy, are trading at much higher multiples of their cash flow, maybe 9 or 10 times.
Now, why is that? Is that because of this distortion related to the hedges? Is that kind of the conclusion as to why one group would be more valuable, at least in investors' eyes right now, why they pay more for the same kind of company?
Absolutely, Pim, because I think people are focusing on near-term earnings estimates for the next several years, and if I've already locked in a very favorable power price based on where the market was a year ago or 2 years ago, then I'm really not seeing the potential fall-off in cash flow and earnings that these companies will experience when they reprice at the market when those contracts roll off.
Now, having said that, though, is it possible that they could just continue to do this kind of hedging so well that it just goes on year to year to year, and that it really doesn't matter because that gap is going to kind of stay there forever?
Well, but I think the point that we're trying to make is when you go to recontract, you're going to recontract in today's pricing environment, which happens to be significantly lower than prices were a year ago. So none of these managements are purporting to argue to investors that they can beat the market. They're really doing this in order to create cash flow and earnings stability. If, on the other hand, management were actually capable of beating the market on a consistent basis, then I think you'd be adding value. But in this particular situation, that's not what management's trying to accomplish.
All right, so by using these hedges, as you say, just trying to be consistent in their sort of day-to-day operations, but eventually, well, a hedge is a hedge. It's not meant to actually produce profits. That's not their main business.
Correct.
All right, we're going to continue the conversation more with Paul Fremont of Jefferies and Company. We're going to use some of this new analysis to find out which companies, which stocks offer the best value at current prices.
I think he's picked a number of things that are really important. You know, in other words, I think making the healthcare system more affordable is important. I think making clean energy a national advantage is very important. You know, my sense is that the stimulus has got to get faster. It's got to have more impact, and we've got to see it get out in the economy.
That was GE CEO Jeffrey Immelt endorsing President Obama's clean energy bill and saying the stimulus has had a faster effect to jumpstart the economy. This is Taking Stock on Bloomberg. Now, after lagging the S&P 500 for much of the year, are utility stocks about to make a comeback? Well, let's turn to an expert, Paul Fremont, analyst at Jefferies and Company. He's got some specific stocks based on some new analysis tools we just described, sort of peeling away the hedges to get a clearer look at the landscape, as you say. So what companies are currently undervalued using this new analysis tool?
Well, I think our best ideas in the space right now would be Constellation, NRG, Entergy, and Allegheny.
All right, let's go through those. I mean, let's start with one that is the subject of a takeover bid right now, NRG. What do you think is going to happen there? Is this a situation where waiting is going to get them a better price?
Well, the Exelon board is scheduled to meet on Tuesday, and they're supposed to come back with a decision on what they want to do next. We believe they will either have to offer substantially more for NRG to NRG shareholders, or they will end up walking away. However, if you're an NRG shareholder, I think you win either way.
Why is that?
Because the value gap between NRG and the other pure merchant names, such as Dynegy and Calpine, is enormous. So if Calpine is trading at 9 times EV to EBITDA, and NRG is trading at 6 times EV to EBITDA, the stock will likely go up. And in fact, Calpine has almost tripled over the course of the past 2 or 3 months, and then has retreated some from its high point of 14.
Do you think the board of NRG is going to be waiving your new analysis tool in front of the Exelon the board to say, look, we deserve a higher valuation? I mean, if the Exelon bid for NRG goes through, what does that do to the overall value of Exelon?
Well, I think not only has the NRG board been very reticent to accept the Exelon offer, but we've seen some very outspoken shareholders recently indicate that the Exelon bid is simply not enough. So I think time will tell, but I believe that you will probably see a significant increase in what Exelon is willing to offer shareholders.
All right, and that we've got to wait until Tuesday to find out more details as a result of the Exelon board meeting to discuss and deal with this bid. All right, let's turn our attention now to Constellation, another of what you describe as the merchant generators that is trading at a value underneath compared to its peers. What about Constellation? Is there something special there that we need to know about?
Well, I think Constellation is a special situation in the sense that they came close to bankruptcy last fall based on the threat of ratings downgrades and liquidity issues. The company has essentially addressed the problem, which is too high leverage, and there's significant amounts of cash that the company will realize either through a joint venture with EDF for half of its nuclear fleet, or if the Maryland commissioners don't approve that transaction, the company has the ability to raise up to $2 billion of cash through the sale of older oil and gas power plants to EDF under a put arrangement.
Do you think that the Maryland regulators will approve this?
You know, I think the Maryland regulators are extremely unpredictable. And if they had economic sense and rationale, I think they'd understand that there are more jobs to be had in Maryland if they approve the transaction, because there would likely be construction of a new nuclear power plant in the state. The utility would be rated at a higher level, which reduces the cost of capital and keeps power prices down in the state. And the state would benefit from having a sound and financially viable utility. So
I sense a but in here somewhere, Paul.
Well,
I mean, because you said you started this up by saying if they were rational. I mean, is there a but here?
Well, I think they're essentially trying to blackmail the company into giving up significant rate concessions, which the company can't afford to give. So, you know, my advice to the politicians is to wake up and understand that blackmail is not the answer to all of these questions.
All right, and having said that, though, Constellation, you still like the stock?
We still like the stock, and even if they turn the nuclear joint venture down, the company is still able to raise cash through the exercise of the $2 billion put option.
All right, we're going to leave it there. I want to thank you very much, Paul Fremont, coming in from Jefferies and Company, sharing your expertise in the world of utility.